All right, we will get started. First of all, wanted to thank our small group here for showing up today. It's very warm out. Could be doing other things, but we're here and I appreciate it. Um, Especially to the people here online as well. We appreciate you coming. Today we'll be introducing Andy Saran of Behind Genius Ventures. He is an early stage VC out of Los Angeles, California, where it's probably nice like this every single day. And yeah, there will be plenty of time for Q&A. So if you have them, write them down, type them down, and you'll get very good answers from Andy. So without further ado, we'll hand it over to him.
Great. Well, thanks everybody. I appreciate everybody spending their Friday evening with me. I have a presentation prepared here where I'll talk a little bit about myself, my journey into VC, just some general thoughts on VC. When I was an undergrad, I sat through a lot of these sessions and I found that I got most of my value through like the Q&A. So I want to make sure I leave as much time as possible for all of your specific questions. So Garrett, let me make sure I could share my screen here because I want to pull up my presentation. Obviously, Garrett, thank you for the introduction here. So my name is Andy Saran. I'm with Behind Genius Ventures. We're an early stage venture capital fund. We invest in pre-seed and seed startups. Very much a generalist kind of VC. We're not very vertical specific. So we invest in all verticals from healthcare to AI to enterprise to consumer, kind of really up and down the chain. So I went to UC Santa Barbara for undergrad. I majored in econ. I did a double minor in entrepreneurship and writing, professional writing. I did study abroad at the London School of Economics as well, where I did business management and micro econ. During college, maybe like a lot of you, I wasn't exactly sure what to do. Most of my peers were going into like Big Four, consulting, audit, and accounting. But then I had other peers that were very fixated on like more like high level finance, I would say private equity and investment banking. UC Santa Barbara, unfortunately, wasn't much of a target school for investment banking or private equity. My passion was really in tech, and I'll talk a little bit about like why I kind of chose VC out of all the verticals in finance. But my three passions were entrepreneurship, tech, and finance. And again, I'll talk a little bit about that in the next slide. So in college, I was working full time. I paid my way through college. So I was working like retail jobs, I was doing internships, etc. But in the midst of that, I still managed to intern at a few venture-backed startups. I also interned at Agility Capital, which is a venture debt fund, which is basically non-dilutive capital to venture-backed companies. So instead of equity, it's debt. And I also did a rotational finance internship at a bank where I did wealth management, investment management, risk and compliance, et cetera. So I did multiple like positions at a bank. Right after college, again, while most of my peers were going into Big Four, consulting, various things in tech, I actually took a job at Yardi Systems. So Yardi Systems is a privately held technology company based in California. They do about $1 billion plus in revenue, 3,000 employees, 80 offices around the globe. So it was like my first foray into like real tech. And it's not as big as like big tech, obviously, but it's much bigger than a startup. So it was like that happy medium for me. One of my clients at Yardi was actually a private equity firm called Jade Enterprises. And they they basically poached me. They had a need, and I was looking for something different as well. Consulting was kind of burning me out. And just so you all know, we'll get into this a little bit later as well. Like consulting, the typical schedule for that is you fly out Mondays and you're back in your home office on Thursday. So basically every single week I was flying out to different client sites. And thankfully it was regional. But people think like consulting and like business travel is like very sexy and fun, but it gets pretty old pretty quickly. And if you're anything like me, you love a routine and it just throws you out of whack with your own routine. So I was looking for a change. I did private equity for about 2.5, 3 years. And then I worked into to VC, and I'll talk a little bit about how I made that transition. So a little bit more on my end as well. I always had an entrepreneurial itch. So one of the things that my brother and I did, so I'm actually a founder as well. So I'm the founder of a beverage company. We're in 100 plus locations. We're in over 5 states. We just signed a huge deal with the largest distributor in North America. And I was actually told that this is what got me the job at BGV. They really wanted someone with kind of 0 to 1 operational experience. And I should mention that the beverage company, it's bootstrapped as well. We paid through it all out of our own pocket. We didn't take any financing. We didn't take any debt. Our cap table is very clean. We haven't diluted any of our equity. So, between the finance experience and private equity, between the consulting experience, between the internships and the econ, and obviously starting and running a company, those are all kind of the things that helped me, get into VC. I mentioned this on the last slide, but again, the three passions that I had were finance, entrepreneurship, and tech. And VC just happens to be the intersection of all three. So while I was at Jade, BGV, they had an opening for a part-time analyst. And I'll talk a little bit about like location and things of that sort in a little bit, but this is a fully remote part-time position. And I was thankful enough to, I mean, with most VC stuff, I mean, like, to be honest, like a lot of it's very concentrated in the Bay Area, like San Francisco or New York. Like those are like the two hubs. And granted, you have some stuff in Austin and Miami and to a lesser degree, LA and like Seattle, Denver, kind of, sort of. But really, I would say if it's like the 80-20 rule, 80% are concentrated within SF and NY. So, rather than like going all the way, diving headfirst into VC, I thought getting this as a part-time gig to see if I even like it would have been a good, first step. And that's exactly what I did. So did that for about, 6 to 8 months. And then I came on full-time as an associate. Future plans for me, I do want to go back to business school at some point as well. I'm going to be applying in this upcoming cycle. I want to work in growth equity for about a year or 2 years. Again, BGV is like very early stage, so I want to get some exposure to very late stage investing experience and then take that all back and launch a fund of my own. I do want to launch my own micro fund where I'll be investing in, emerging markets where I see high potential in the next 12, probably like, 10 to 12 months, I would say. But then ultimately the goal is to be more of like a crossover fund. If any of you know Altimeter Capital, that's kind of what I'm trying to do. I think a lot of people might be asking, how can you get to VC, right? Straight out of undergrad. And the answer is it's not that easy. Even if you go to a target school like Berkeley and Stanford, and again, they're really target schools because they're so close to Silicon Valley and SF. Even then, you're really looking at like an entry level role, like maybe like in research or like very, very like rudimentary analyst type work. And to be perfectly frank with everybody, those jobs don't pay all that much. What's also challenging, what's also really tough about VC is the recruiting process is not as structured or as rigid as other finance verticals. If anybody's doing like investment banking recruiting, like you have a recruiting season, you have a time when applications are due, then they're interviewing people, you have a super day, and then all the analysts basically start at the same time. VC is absolutely not like that. For one, VCs just don't have that same type of headcount. And number two, it's just, they're not hiring classes and classes of, analysts every single year. What I will say is, a lot of VCs generally want some sort of experience first. And I guess the way to kind of think about that is, and not in a harsh way, but what do you kind of bring to the table, right? Like, is there like technical expertise? Is there operational expertise? And it's usually tough to have either of those things straight out of undergrad. Everybody's paths to VC is very nonlinear. And these are just some actual real world examples of people that I know that are in VC and kind of where they came from. So one of my best friends, he did healthcare investment banking at Moelis for 2 years. Then he went into healthcare VC. I have numerous friends that founded companies. Either they got, acquired or they exited in some way, shape, or form. And then they ended up at a VC. I have a very good friend who's at Andreessen right now. He worked at one of Andreessen's like hot portfolio startups. He rose up the rank and then he got a job at the VC. There are a few like very technical subject matter experts. We're seeing that a lot with AI. So a lot of these folks have like PhDs in like either machine learning or AI. They work in the private sector for a little bit or like a private lab, and then they go into VC. Another kind of tried and true path is like people do consulting or private equity. They go into an MBA program at like a Stanford or a Berkeley, then they go into VC, or you could work in big tech. I know a few people like at Google's like DeepMind or like Meta's like AI research lab. So like a very like elite unit within a big tech company. Or even like I would say like early on, some of the people that worked at Google Search when Google Search was getting built or like Google AdWords, like a lot of those people are in VC now and they're doing very, very well for themselves. So as you can see, each of these ways is very different. They require different levels of education, different levels of experience. There's different skill sets involved, but they're all various ways to get into VC. And this is not all encompassing. Obviously, this is not an exhaustive list. But this is just to give everybody an idea that, there's not just one straight, sure shot linear path into VC. Some tips that I would say for everybody if you're looking to get into venture capital, network. But be strategic when you network, right? I kind of made a little joke here, like Mark and Andreessen may not have the time to chat with you about career prospects in VC, but talk to junior VCs, to people like me, like associates, junior partners, mid-level people. Those people are almost always willing to talk. They tend to be younger in age. So they're probably not super removed from their own college experience as well. Deeply and honestly evaluate your skill set. This is something that I had to kind of do myself. And just thinking about, if I am joining a VC, like what's my unique value add to that VC? Is it something on the technical side that I could contribute? Like, how many wins do I have under my belt? Like, what can I actually add to the VC? This third tip, just kind of take it with some caution here. Get in the arena and start a company. There's no better way to understand VC company building in the startup ecosystem than to just build. And you all are in like the right kind of area to do that. No, this is very high risk. Obviously, this isn't the suggested path for everybody, but it's a great way to get your hands dirty. And if you're like me, you learn by doing. There's really no better way than to start a company. This is another very important tip. Go to where the action is. This can't be emphasized enough. Startup cities are where the magic happens, and the reason why is the serendipity of it. I can't tell you how many times, some of my friends in SF, they'll just be in a coffee shop and they'll run into some big shot VC and they'll just strike up a conversation, or they'll meet someone at like a hot tech company. And that'll lead to some conversation that leads to either them getting hired or they hired someone for their company. So that happens all the time in SF in New York, more often than you would think. And I'm actually shocked by how often it happens. Kind of on the last slide, almost everybody has like a very non-linear path. So find your own path. Breaking into VC now in 2024 is way different than like 1999 or something. So a lot of different ways to get into the business. Find your own way and just double down. Last one is just stay very curious. This one's a little bit personal to me because we're a generalist fund and we invest across all verticals, but be a voracious reader, explore your interests, review like kind of your information diet, like where you're getting your news from. Understand what's happening geopolitically and macroeconomically, because that has a big impact on VC, whether people admit it or not. And just be a technology enthusiast. I'm always on test flight. I'm always downloading apps. I'm always checking out new products, new hardware. And it always just kind of helps inform my own perspective when I'm analyzing investments. Some VC trends I'll get into. This is some data that I pulled from Fred. And I'll kind of give the context on this. Everybody's like, I'm sure everybody knows this, but like interest rates, we were in a period where interest rates were very much zero. And we called this ZIRP. The zero interest rate phenomena period. And I'll talk about the implications that this had for VC kind of on the next slide. So without getting overly technical, but when you're in an environment of like zero or very low interest rates, the cost of capital is low. And what that means is your hurdle rate is also low. So just to give everybody an idea of like what a hurdle rate is. So when you're investing in VC, and by the way, if I lose anybody, please ask me questions at the end if any of this doesn't make sense. But when you're getting money for VC, you're getting money from LPs, which are limited partners. LPs could invest their money in anything, right? They could invest their money in gold. They could throw it into crypto. They could throw it into public equities. They could throw it into S&P 500 and get 7% per year. The risk-free rate is generally pegged to treasuries, like the 10-year treasury, which I think is like at maybe 4.5%, 5% now. So basically what that means is someone could just take a bunch of money, throw it in a 10-year treasury or a bond, and they could just kick their feet up and relax and get a return of 4.5%, 5%. So with VC, obviously, given the risk premium that's involved in investing with VC, you want to be able to, at the very minimum, not only beat that hurdle rate, which again is like market standard is about 4.5%, 5%, or wherever the 10-year treasury is, or like wherever the S&P 500 is. You want to be able to not only beat that, but exceed that by multiples. So we're talking like maybe 10, 12, 15% return on your investment. And again, a lot of that is a premium based on the risk. And a lot of that's based on the fact that the capital is locked up for 10 years. So there's no liquidity involved. VC now, as a result, is very different than it was a few years ago. And I have some comments on this on the next slide. What the uptick in interest rates kind of did is it caused a lot of public market corrections. And obviously, if any of you guys follow like tech companies, some of them have rebounded, but some of them haven't. We've seen a lot of layoffs. And what that really did is that reset valuations across the board, but it also froze the IPO market. And the reason that's troubling for VCs is, again, a lot of us make money when our companies go public or they get acquired, right? So basically IPOs and M&As were basically shut across the board because obviously no one wants to IPO in like a very volatile environment. What did that mean during a market slowdown? Less deals, lower rounds, and lower valuations. And this is some data that I pulled from Crunchbase. And it actually came through EY, where you could very aesthetically kind of see the downtrend, not only in funding rounds, but the number of deals. Obviously, the hot topic right now in tech is AI. It's like you can't go very far without hearing AI in either tech news in the Wall Street Journal and in VC circles. So I think it's worth talking about that a little bit because I think it's going to fundamentally shift how technology works in the future. So incumbency risk is like a very big risk in AI investing. And the reason for that is, again, a lot of these like smaller AI startups, you're dealing with companies that have enormous R&D budgets. So OpenAI got 10 billion from Microsoft, Google, Salesforce. I mean, these companies, or Apple, I mean, they're just sitting on billions of dollars in cash, and they have enormous R&D budgets with enormous R&D teams. So it's tough to compete with that, right? AI is moving so quickly that we see like OpenAI, they just come out with like a feature update and it just kills startups every single week. So it's a fast moving space. The incumbents have a lot of money to spend. They're iterating very, very quickly. So it's a space we're watching very closely. Obviously, we have a lot of investments in AI centric companies, but you just have to really do your homework here and not dive into the hype cycle. Like I mentioned, there's OpenAI, there's Anthropic, there's Google, Cohere, Mistral, and there's so many companies coming out, all the time with these major raises. Key constraint on a lot of AI startups that I've seen is like the cost to compute. So every time, if you're relying on like some sort of foundational model with like OpenAI, you're using their API, every time someone runs a query, it's an API call. That costs money, right? And that tends to compress your margins, but that cost is being brought down pretty considerably. And in relation to compute, I guess the next kind of bullet point there is a lot of the value that I see being captured is the picks and shovels companies. So the picks and shovels analogy comes from the gold rush of 1849 in California, where, a lot of the people that went out there for gold, some of them hit it rich, some of them didn't, but who really made the money were the people that were selling the picks and shovels to the gold rushers. And that's kind of what we see on the infrastructure side with AI, where you see NVIDIA, obviously they had a correction the other day, like the last week, but their stock has been doing tremendous. Microsoft, Grok, there's all these companies out there that are really capitalizing on the infrastructure layer of AI. One last thing I don't see a lot of people talking about, which I'm paying close attention to, is kind of like the intellectual property aspect of AI. There's a very big lawsuit between the New York Times and OpenAI, where OpenAI was apparently scrubbing some information from like old New York Times articles. So it's like, who owns that data, right? I think a lot of that's going to be adjudicated. We're seeing a lot of stuff in like the entertainment space, which is near and dear to me because I'm in LA. Like the actors union, the guild, they had a big strike about like, part of it was actually related to AI and replacing like screenwriters and actors and like the Hollywood space and how AI is going to disrupt that. So a lot of interesting things here, and I think it's worth watching. So obviously, approaching hype cycles with a healthy dose of skepticism. So that applies to AI, Web3, crypto, AR, VR. VC's changed fundamentally, I think, in the last year than any time the last 5 to 10 years, because I think the way VCs will make money now won't be how they made money in the past. VCs are more conservative now, is kind of what I've noticed. And that's mainly because they're LPs now. They want distributions. So DPI is distributions to paid-in capital. So all those companies that raised, or all the VCs that raised in 2020, 2021, when the capital was low, they threw a lot of money out at a lot of companies at very high valuations. but in the coming years, they have to return that capital. And there's a quote that I really like from Howard Marks. He's of Oaktree, if you don't know. But you can't eat IRR, and IRR is internal rate of return. So basically, IRR is a paper markup, right? So paper markups are great. They're great in the short term, but eventually you need to convert that into cash. And I think that's what we'll see a lot more of in the future. Some spaces I'm watching personally, a lot of AI stuff happening in medicine and healthcare, which I think is very exciting. AR and VR, I think, is still very promising. I put a little question mark there because Apple Vision Pro was supposed to be the big AR VR moment, but it just never quite materialized. National defense, that's something that's really taking hold here in LA. There's a city called El Segundo in LA where a lot of folks are kind of iterating there. Anduril is a startup that just got awarded a very big Air Force contract earlier this week. So a lot of people are innovating in like autonomy and like national defense. Infrastructure, supply chain resilience, manufacturing and reshoring, nuclear energy, high-tech manufacturing, hard tech, deep tech. These are all very, very hot spaces that everybody wants pieces of. I'll talk a little bit about due diligence here. Kind of what we do in the early stage versus late stage. In the very early stage, to put it quite simply, you're dealing with low information. It's a very high risk but high reward. I would say it's less quantitative. I think I got those backwards. It should be less qualitative and more quantitative. That's my error on this slide. It's less quantitative because you're dealing with less numbers, right? These are like, generally pre-revenue or very early revenue companies. You're really making a bet more on the founder, more so than you are anything else, because again, you don't really have a lot of quantitative numbers to go off of. These deals they tend to not be the really sophisticated deals. They're usually raised, on a safe, which is a secured agreement for future equity. So they're not these overly, complicated transactions with multiple investors on the cap table. So contrast that to late stage investing, where you have a lot of information. You're getting in very late, so it's a very low risk, but it's also low reward because you're coming in at a higher entry price. This tends to be a lot more quantitative and less qualitative because you have years and years of data. At this point, you basically have product market fit. You have years of revenue. You have years of data to go off of. So you could run a very sophisticated analysis on how the company's going to do. You could, forecast outward. You're really analyzing now at this point scalability. You're looking into new markets, new product suites. You're looking at company culture, things of that nature. And again, these transactions just inherently tend to be a lot more complicated. Just two examples that I kind of pulled up. So you have Cognition on the left there. So that's a 6-month-old AI coding startup valued at $2 billion. My indications are saying this is pre-seed. Company's only 6 months old. No revenue. They kind of raised a lot of money just based on a demo. And what Cognition is, if you guys are interested, it's basically an AI software engineer. They have a very, very cool demo out there that you guys could probably find on YouTube. But they raised $175 million at a $2 billion post-money valuation. Contrast that to the right, you have Rippling. So Rippling was founded in 2016. They raised their Series F, which is very late stage. So you have pre-seed, seed, Series A, B, C, D, E, and F. My guess is they're probably bucking the IPO market for now, just until the market kind of recovers, and they'll probably look into IPO maybe late this year, early next year. $350 million in ARR in 2023, up 100% from 175 in 2022. And it looks like they're going to be raising about 870 million, 200 million with 670 million in buyback. So obviously you guys could see the level of sophistication at the later stages is fundamentally different from the early stage. What do we look for at the very early stage? Founder market fit is a big thing, right? Is this the right person to solve this problem? We look for, high execution velocity. How quickly are they iterating and shipping product? The underlying business model. How scalable is this? So, me personally, I look at stuff that late stage investors would look at. I look for signs of that at the very early stage. Some degree of traction is useful. If it is pre-revenue, do they have a wait list? Is there interest? And basically the question we're trying to answer is, will someone pay for this? And if someone will pay for this, will many people pay for this? Technical know-how, that's getting increasingly important, especially as AI is becoming more prominent. Market sizing is very critical. How big of a market is this? And can this generate venture scale returns? I think that's very important. Funny enough, the second last bullet point is this even a problem to begin with? Right? I think there's a lot of companies out there, not a majority, but a small number of companies that are just solving kind of like non-problems, or, the problem they're solving for is already kind of appropriately, catered to by existing solutions. So there's not really a wedge or really a place for the company. And just a note, when we do evaluate startups and founders, we don't really care like what school they went to. We don't really care where they worked. A lot of that is very immaterial. We really care about the founder's ability to execute and really kind of the validity of the idea. Just some closing thoughts here. You all could take down my email, Andy@BehindGeniusVentures.com. You could contact me for anything, any VC related questions. If you're starting a company, needs startup advice, if you want me to make you introductions, any sort of idea validations, if you just want to talk VC, whatever it is, you're more than welcome to reach out. Hopefully sometime this weekend, I will reach out to, or I'll send to Garrett like a Google Doc full of just like VC related information that I found valuable. So that'll be books, podcasts, talks, articles, websites, thought leaders, and people I follow. In addition, I'll also send people some job boards as well, that are specifically catered to VC. That's where you could find like VC internships, VC fellowships, and things of that nature. And that's it. I guess it's time for Q&A.
Cool. Well, thank you, Andy. That was very good. I think we all had something to take away from that. So yeah, let's give him a round of applause. All right. Does anyone want to get started with a question?
Oh, you?
No.
I have a few questions.
Yeah, go for it.
Okay. Can you hear me from here?
Barely. I think we'll be all right.
Just speak up, I guess.
Yeah. So hey, Andy, thanks for taking the time to speak with us today. So I'm a finance major in my senior year. What advice would you give to someone who's looking to like maybe intern at a VC, like, it's like just in general, intern or work full time and like in the VC space? What skills should they have? What skills should they obtain? What software should they get accustomed to? Like things of that nature, like, just in general, like what advice would you give?
Yeah, that's a great question. I would say for any finance period, whether it's VC, whether it's private equity or investment banking, Excel. Again, you use more Excel at the late stage. I would probably equate late stage VC more akin to private equity. That's kind of like the nature of the deals that you're doing. So like Excel is like very, very important. So that's the software side. In terms of like getting into like either interning at a fund or anything like that, networking is very important. You'd be surprised how many like, I guess you could call them off-market opportunities there are in VC. And, a lot of VC like postings and stuff aren't posted. A lot of them are just, warm introductions, or someone knows someone who knows someone who's looking for something. A lot of stuff doesn't really hit the job boards. But always just one of the bullet points I gave, one of the tips I gave is just take a deep evaluation of your own skill set. And that's something that I had to do as well. Be very introspective and not in a harsh way. Just think about, what value can I add to a VC, right? Like what can I bring to a fund? Like what expertise do I have? And that could be, very good Excel skills. That could be like very intricate, like financial modeling skills. That could be like, I'll give you an example. Like, there's some like crypto specific funds, right? And I can't really add that much value there. Like I know crypto like very peripherally, but I'm not a crypto specialist by any stretch. Or, for like a very AI centric fund, like I have no formal education in AI. I don't have a PhD in AI. Right. So like for me, like there's just not saying that I can't do well there, that anybody else can't do well there, but like someone who's like very specifically catered to that vertical will probably do a lot better than I would. And they just add more value. So my tips for you, get very good at Excel, like exemplary good, because that'll follow you anywhere, whether you decide not to do VC and you decide to do another vertical in finance, whether it's asset management, IB, PE, anything, Excel will serve you well. or if you're going to start a company, you'd be surprised how many, obviously in your own company building, you'll do Excel. I do Excel every day. So that would be probably what I say. Network your butt off, build good relationships, focus on your own skills, and learn Excel.
Cool. We have a couple questions here in the chat, Andy.
Oh, let me take a look.
We will start with Alex's question. If we are struggling with finding early stage employees, is joining an incubator the only chance that we have?
If we are struggling with finding early stage employees, is this coming from like if you have a startup and you're looking for employees, or maybe some clarity? I think it was Alex asked that question. If you could add some clarity there. Oh, starting a startup. Okay. Okay, so you and your partners are starting a startup and you guys are looking for like early stage employees. Is that right? Okay, perfect. Okay, so you just confirmed, yeah. I guess, it depends on the stage, right? I would just take a close look. I mean, if it's you and your partners, I mean, that's a really good question. Ideally, you shouldn't really need, like at the early stage, I mean, you shouldn't have like a big staff or anything. I think it may serve you well. This may not be the answer that you want to hear, but I think you'll benefit a lot from distributing a lot of those duties amongst that small team that you have yourself, because you'll get very scrappy and you'll get to know very intimate parts of your business. I mean, when like in like my brother and I are a beverage company, right? Like we're the CFOs, we're the CEOs, we're the COOs, we're the CMOs. We do everything ourselves, right? Like we hardly outsource anything, but what that allows us to do is just be very intimately familiar, with every angle of our business. So what I would say is try to keep in as much as you can just for your own benefit. And at the same time, that's controlling your burn, right? I don't know what your cash position is or how much you're paying these early stage employees, but another thing you should be mindful of is the more employees you have, oftentimes at the early stage, since you're not paying them, multi six-figure salaries, hopefully not yet, but you're probably paying them in form of equity, right? So you also want to be very mindful of how much equity you're diluting to your early stage employees. The last thing I'll say on that one, Alex, is if you're really looking for someone, there's a website called layoffs.fyi, and everybody could note that down. That's a list of it's basically an open source kind of website for people that have been laid off from tech companies that are looking for work. So like I know someone that got like a Tesla like hardware engineer not too long ago from that website. So it's open source. You could see all these people's LinkedIn's. You could see their emails, etc. And that could be a good source of, maybe you might find someone, but at the very least, maybe you could have a conversation with someone who could lead you to someone who could lead you to someone who could lead to a hire. I hope that's helpful.
All right, we'll move on to the next one. I saw one from Sanskriti. If you were to have an intern in your future fund, who would you get on board, and what qualities, skills, strengths will you look for? What problems will you expect them to solve?
That's a good question. That's still a bit of a ways out for me, so I haven't thought too deeply about it. But obviously running a fund, it comes with a lot of very unique challenges. BGV, by the way, is a very small fund. So I see all aspects of the fund, even like the not so sexy sides, right? Like the auditing and like the taxes and like LP relations. And like, it's not all just like, very sexy tech investing. Like there's a bit of a boring side too, right? A lot of administrative stuff, a lot of data cleanup, things of that nature, which I'm involved in. For an intern, I think the main thing is probably what I would call like intellectual horsepower, just like general curiosity, I think is like a very big thing. Like obviously like anybody hiring an intern doesn't expect that intern to know VC like the back of their hand yet, but I would hope that they have like the aptitude and the willingness to learn as well, and the willingness to learn very quickly. So yeah, because honestly, me in college, as interested as I was in VC, like looking back, like me in undergrad, I didn't know anything about VC. I probably knew 1% of what I know now. So just someone who's willing to learn, someone who's very curious, someone who has like intellectual horsepower, who's willing to get outside of their comfort zone. And someone who's just, as passionate for founders and helping find the next hottest companies and helping founders out and finding those like top 1% companies, as passionate about that as I am. I hope that answers that question.
Does anyone here have any questions right now?
I mean, I got the question.
Okay.
Hi, I'm David. I'm currently a freshman here and I'm going for my MBA and MIS and I'm like confident at it. I was wondering why, considering you already have such a successful career and you have more things you want to achieve, why do you still plan to go back to college in the recent year or whatever it was you said?
Yeah, no, that's a good question. Yeah, I think, for me, again, like, I guess it's two things. I think number one, networking is like a very big thing for me. So obviously in like an MBA setting, like you network with tons of people, you meet excellent classmates that are going to go off and do hopefully amazing things in the world. The second thing is, again, I really want to work in late stage investing, whether that's tech private equity, whether that's like, again, like an altimeter, like a Coatue, or even maybe like a SoftBank to some degree. Those positions operate more like investment banks and private equity, meaning they're a lot more structured. They have a lot more headcount. They're not like early stage VC. So those tend to be a lot more formalized investing positions. So I would definitely want to work. And an MBA, by the way, is like one of the surest paths to get one of those positions. Do that for like a year, 2 years. And then, that's really a means to an end for me, right? It's just you get that under your belt. So at the end of that, I can kind of take a look at my acumen and say, okay, I did consulting, I did private equity, I did early stage investing, I did late stage tech investing. So like at the end of the day, have kind of seen full cycle, like the investment, like start to finish, A to Z. I've basically seen every stage of the investment cycle. And that'll kind of align with like wanting to do a crossover fund. So for me, it's more like to get into like a more structured finance position, which, an MBA tends to be, and do that for a year or two, and then take all that knowledge back with me, to a crossover.
All right, thank you. That definitely makes a lot of sense.
Yeah.
All right, we have a couple of questions here in the chat. The first one we had is Sanskriti said, I'm a student entrepreneur building an AI journaling app. That sounds interesting. Do you think joining a VC focused on AI tech investing would be a good idea to understand the infrastructure of companies in the space? Which VCs would you recommend?
Okay. Good question. I would say, which VCs do I recommend? I think I might have said like there's some VCs that hyper focus on AI, and like there's a few of those, but I'll say AI is so ubiquitous now. Like everything has AI. Like every pitch I look at has AI in it in some way, shape, or form. Like there's almost no exception. So with that being said, like almost every VC is like to some degree like an AI VC, right? I mean, they have some exposure to AI in their portfolio. I would say, if you're a student entrepreneur building something, I would network with VCs, talk with VCs. I wouldn't jump straight to VCs. I would just learn as much as you can, building your company. I think one kind of knock that some VCs get is like, there are some VCs out there that, they haven't really started a company, right? Or they haven't really been in the trenches like as a founder. So you'll gain a lot of expertise and you'll have some battle scars to show for it, I'm sure, but you'll learn so much just by being in the weeds and operating. So I would say talk to VCs, interact with VCs, focus on building your company. Obviously, I gave my email out, so like you're more than welcome to email me if you ever want to run anything by me. But yeah, I would just continue building. And VC could come secondary to that, is what I would say.
All right, we have a couple more here. Alex, yes, we will get you clips of the recording at least. I'm not sure when, but we will get them to you. Sanskriti said, in this next phase of your career, who are you looking to network with? How are you going about it? Who are the top 3 advisors on your mental e-board?
Okay, the next phase group, who am I looking to network with? I mean, everybody, I mean, across the chain, like I'm always looking to network with founders, people that are at, some of these hot tech companies like Anduril or OpenAI or Google or anybody. There's not really like an archetype for who I'm looking to network with. I think in like relating back to like the question about like networking in the context of an MBA, like you have a lot of, hopefully if the program's like recruiting like a very diverse kind of pool of people, you'll hopefully have people from all sectors. I'm a firm believer that you could learn something from anybody and everybody. So whether it's people working in government and like public policy, there's not like a specific archetype of who I'm looking to network with. Who are the top 3 advisors on your mental e-board? Top 3 advisors for a mental e-board. I don't know that I don't really have a good answer to that question. I would say, I mean, there's like thought leaders that I listen to, obviously. Obviously not everything anybody says is like gospel per se, right? Like I think I do a good job of like taking in like multiple viewpoints when I'm thinking about something. But yeah, I don't really have a top 3. I haven't put too much thought into that. I'm very much like a sponge. I try to listen to as much as I could.
All right. Yeah, go ahead.
Andy, I'm just curious, like, how do you prevent burnout, and like, what are some of your hobbies outside of like work?
Yeah,
Great question.
that's a really good question. I'm a huge like exercise and fitness enthusiast. I go to the gym every single day. That's like a good way for me to unwind. Thankfully for me, I mean, like reading and just like going down rabbit holes is like kind of therapeutic for me. I really enjoy that. That's like a way for me to kind of like I guess it's like how do I say it? It's like no strings attached rabbit hole diving, right? Like I'm not doing it for any particular purpose. It's just out of like pure curiosity. I'm not like, investigating a company or doing any research to kind of like either justify or look into like an investment decision. It's just for my own curiosity. I find a lot of joy in that. And yeah, just like maintaining a healthy lifestyle, like healthy eating, like prioritizing sleep, working out very consistently, having a good workout routine. I meditate, you know what I mean? Like 10 to 15 minutes a day, just like mindfulness. Keeping like a clutter-free like environment, I guess, too, to kind of ensure that I'm thinking clearly about things. Yeah, I would say that's the best way for burnout.
Yeah, what do you read, by the way? Like fiction, nonfiction, like aside from like the market updates and what's going on in the market, like
Yeah, it's honestly all nonfiction. A lot of stuff on like I read like a lot of stuff on economics. I'm reading a really good book on like Saudi Arabia right now. There's a book on semiconductors called Chip Wars, which is like a Financial Times bestseller. I'm reading that as well. I'm usually reading multiple things at once. Because if I lose interest in, like on any given night, I may not be super enthusiastic about what I was reading last night. I might want to read something new. So like I'm always like going through like 5 or 6 books. So I'm reading quite a few things, but yeah, generally tends to be nonfiction, like a lot of stuff on geopolitics, economics. I don't really do like self-help books all that much. I think there's some good ones out there, but I don't really do much of that. But there's a really good book on venture, by the way, that I'll throw in the Google Doc. It's called The Power Law. And that was like a financial time. That's a really, really, really good book that talks about like the history of venture capital that I suggest, like if you're even remotely interested in technology or venture, like I suggest reading that. So yeah, generally nonfiction is what I tend to read.
All right, we have a question from Sal here in the chat too. Do VCs typically provide human capital to their portfolio companies, or is it more of a silent investment with a board seat? Broad question, as VCs have a wide range, but was curious on what you see.
Yeah, that's a good question. So Sal, I would say, yeah, we absolutely provide human capital. I mean, so like investing is like one part of VC, but the other part is like portfolio management, right? Because I mean, these are the companies that we're hoping, like we do everything we can to ensure that our portfolio companies succeed. So whether that's making, customer introductions whether that's making introductions to like downstream capital, like more fundraising, whether that's introducing someone who could like do like a key hire. Like one thing that we do at BGV is like we do like executive coaching as well for the founders. I think that's like super, super interesting. So we do like these executive coaching sessions where we get all the founders in, and it's kind of like a therapy session for founders, but not so much. It's more like business building and like again, like the name implies, executive coaching. So we do spend a lot of time like working through, especially at the early stage, where there's like a lot of room to pivot and a lot of room to like kind of not necessarily change direction, but a lot of big decisions need to be made in terms of like how this company is going to grow. Should we build this? Should we build that? Should we focus on this market? Should we focus on that market? Should we ship this feature? Should we ship that feature? Like one thing that we had, like one like decision that we kind of helped the founder through not too long ago was like, you know, continuing to outsource dev versus like hiring like an in-house like CTO, and just kind of going through like the costs and like the equity and like kind of like the financial implications of that would look like. So yeah, I mean, we do provide a bunch of, I'm not sure if I would call it human capital per se, but like a lot of like portfolio support. I would say that's like half the job, honestly. It's like working with the existing founders. We generally, I mean, board seats generally go with like the size of the investment that you make, and you'll generally see more board seats kind of the later on you go. But yeah, it's almost never just like a silent investment with a board seat. It's pretty active, like hands-on management for the most part. But at the same time, just giving the founders, like we're not the CEOs, like we're not the founders, like we're not running the company. But we do everything we could to help out.
Cool. We have another question in the chat here from Sanskriti. What's your favorite company in your VC portfolio and why?
That's like asking who's your favorite kid. That's tough. I won't answer that. Just I mean, you could look at our portfolio online on behindgeniusventures.com. A lot of cool companies out there. We just closed our fund 2, by the way. So a lot of our fund 2 investments, which I can't like really talk about right now, a lot of those will be announced in the near future at some point. But I would say they're all my favorite for sure. I mean, we had conviction in every single one of these companies, and they're all innovating and they're doing something very cool. And we saw a tremendous opportunity each one. So I can't favor one over the other. I see a follow-up question here from Sanskriti. So the financial metrics you look at using Excel to evaluate potential companies. That's a good one. I mean, and again, I think that kind of depends on stage as well. And I think that depends on the level of revenue that a company has. One thing that we look at, this was actually a very like controversial thing, like on X, and like it kind of went viral, is like when early stage companies have like financial projections, right? Like how much does that matter, right? So if we're talking a company that's like, let's call it 6 months old and they have no revenue, like how can you reasonably forecast what your revenue in year 15 is going to be? I mean, it's almost impossible, right? I think for me, so like some VCs chimed in and they were like, yeah, we don't care about that. Like the founder should just focus on like building the company. Who cares about financial metrics and projections? But then the other side of that token is like, yeah, like maybe the projections may not be super on point, but what you can kind of gauge from that is like underlying business acumen, right? And like whether there's like a sense of realism in the projections. Like, you know, is it possible that you'll be generating like $1 billion in revenue by year 2? Probably not, right? But so you could kind of like sanity check these projections. In terms of what we look at internally when we're like modeling something, obviously we look at like, depending on how much money they've raised, like their current cash position is a big one, their current burn, their runway, kind of like what future revenue like wedges look like, you know, do they have a lot of like LOIs out currently? LOIs are letters of intent or letters of interest. So, you know, we look at like how much potential revenue is kind of hanging out there. What are some like untapped markets, and what are we call it TAM, total addressable markets. Like what are the size of those markets, and what could those mean if you tap into those markets? So very kind of across the board, it kind of depends on the company and how much they've raised.
Yeah, we have one more question from Sanskriti here, but I want to give everyone here a chance, like if they haven't asked a question, like now's the time. We're running a little short on time. So Does anyone else here have any questions right now? Okay,
Question, just, I want to make sure everyone has a chance.
sure.
You do a lot of this, Andy, like with the whole like AI stuff and like VC. Where do you see the future of VC and like what should we at least maybe expect potentially in this space going forward?
With respect to AI specifically or VC in general?
VC in general.
I would say what I'm observing is like there's this very like, I don't want to call it like patriotism necessarily, but like there's a big thing on like Andreessen just raised a huge fund called the American Dynamism Fund. And there's a lot of founders that are building in domestic infrastructure, domestic defense, cybersecurity, nuclear energy, climate, like very, very big. Space is like a huge one, right? Where it's like kind of the thesis is like, if we're in like a global competition with other countries like China, India, Brazil, Europe, et cetera, like how can we make the US kind of stand out? That's where I kind of see a lot of the excitement, to be honest with you. There's a lot of really, really cool companies that are out there. And again, it's like on the lines of like AI at the end of the day, it's like almost like a global arms race, right? Like who could attract the top talent and who could build the quickest? Because I mean, we could go on and on about AI, but like, I mean, there's like some pretty serious like national security implications, things of that nature, right? So I think like it is almost like a bit of like an arms race in sectors like AI. Things like nuclear energy is like another big one. Defense is also huge. I think like with defense specifically, you're seeing stuff like in like whether it's like the Israel-Hamas thing or like the Russia-Ukraine, like the importance of like drones, right? And like autonomous weapons is like a very big thing. VCs have traditionally, there's been a big conversation about VCs traditionally staying away from like weaponry and like military, just like the ethics of that is like very controversial, but I think a lot of people are looking at it more in terms of like defense and like saving human life. So I think that's like also cybersecurity is like another huge one, like protecting internal data and internal information. So a lot of innovation there. In terms of like what VC will look like, I think VCs are getting a lot more conservative now than they've been in the past. I think the idea that like someone could just like whip up a website, throw together a deck and raise like 10 million from SoftBank in a week, like that's kind of gone. You'll have hype cycles here and there, but I think like VCs are getting a lot more diligent because I think their LPs are also getting more diligent and tightening the belt. And again, they're also expecting distributions, right? Like I said, like the Howard Marks quote, you can't eat IRR. Paper markups are great, but eventually there comes a point in time where you have to distribute capital. And ultimately, at the end of the day, a VC is just a money manager, right? They're just they have a fiduciary duty to their LPs, and they're trying to return as much money as they could. So paper markups are great, but eventually push has to come to shove, and you have to distribute. So yeah, I hope that answers that question.
Yeah, I did. Thank you.
Okay, perfect.
All right, we'll get to this last question here in the chat from Sanskriti. I'm struggling with my financial projections for Journally, pre-seed startup. These projections are bane of my existence. Haha. How do I go about it?
Let's do this, Sanskriti. Just email me, and I'll give you some pointers because at the early stage, it's very tough to model your projections. But I would say don't stress too much about financial projections. That should come secondary to the product, I would say build the product, be product first, ship as much as you could. Ship meaning ship out features. Get some users, get feedback from those users, and just build. I think at the very early stage, worrying about like stuff like budgets and financial projections and stuff, that could be a distraction. I would just say put your head down and work, build, and then once you actually have people paying for the app, once you have like some general traction numbers, like, hey, we're growing, 20% month over month. If you have like 6 months of data, you could kind of extrapolate that forward, and that could be the foundation for your financial projections. I think what you should start with is just getting some traction, get some numbers, and then build off of those.
So my question is, which stage in funding do you find it most difficult for startups? Like whether it be pre-seed, seed, series A or B, like after they finish this stage, they're like, they got like a relief off their shoulders, like, they're way better in operating. I guess they finish like their innovative stage. Like, basically like what stage is like, okay, we got through this, like now the next stages are going to be easier to go?
That's a very good question. I have I'll give you the honest truth. Like it never gets like easy per se, right? There's like not a single stage that's easier than the others. I think the later you go, the more formal it gets, right? And what I mean by that is like at the later stages, like you're gearing up for like an IPO, you're probably having like audited financials and like you have investors and board, you have like I mean, you have investors from the early stage, but you have investors taking board seats. You're thinking about board construction. I have a friend who raised like a very big Series B, and he was like, yeah, on one end, like it was the most relieving thing, right? But on the other end, he's like, I've never been more stressed in my whole life. Like I've never had more weight on my shoulders. Um, I would say where it gets very challenging is when companies raise at very high valuations. Let's say, I'm just going to throw some like random janky numbers out there. Let's say you raise a Series A at like, I don't know, 500 million post-money valuation, half $1 billion. What that means is you have to fill those shoes in, right? You have to fill in that valuation. So like this example for Cognition, right? This 6-month AI company that raised, at a $2 billion valuation at seed. For subsequent funding rounds, unless they do a down round, they have to live up to those expectations, right? So that's where it gets extremely stressful and it could get extremely hard. And I'm never one of those VCs that encourages companies to do like a down round. It just comes down to being very realistic. I think it sounds very good to like raise at peak valuations, raise at the highest valuation that you could. Investors like that too. But downstream, that could present some major problems if you're not able to grow into those valuations, especially if the metric evaluation changes, meaning that there's like a higher bar that's expected, which happened very quickly within the span of a year when the interest rates went up. It could get very stressful living up to that hype and those expectations. I would say at the early stage, it's very fun, right? I mean, it's not fun per se, but again, you have a lot of creative kind of freedom, right? And then later it gets more formalized. You're dealing with bigger amounts, more sophisticated transactions. You're almost operating like a publicly traded company in a lot of ways. So, I hope that kind of helps a little bit.
Yeah, I guess like it kind of depends on like the company, but it's all personal preference on.
Yeah, I mean, there won't be a stage that's like easier than another, but like again, depending on what you raise at, you could be dealing with like more or less stress than someone else, depending on the business you're building in too, right? I mean, like the vertical you're building in, the type of competition you're dealing with. It could be, there could be a whole multitude of factors very specific to your specific company and your startup that could be, causing you stress or maybe making you a lot of money. I'm not entirely sure, but I would say, the later you go, obviously, the bigger numbers you're dealing with, the more formalized it gets. You're answering to more people. You have more investors, more shareholders. And you obviously have to be very, very careful, especially as you go up, like you're up for like an IPO. You have to cross your T's and dot your I's from like a regulatory and like compliance standpoint. So yeah, I would say it never really gets easy, but the nature of your challenges changes pretty substantially.
Okay, thank you.
Yep.
Looks like we have one more in the chat here.
I see it.
Okay.
Would you say venture capitalists and early analysts get commissions and bonuses based on the performance of the portfolio companies they propose? Is starting one's own fund the only way to build wealth in the VC space? Or are there other ways? To the second one, is starting one's fund the only way to build wealth in the VC space? Absolutely not. There are people at like very, very big funds. I'm talking like Andreessen, Sequoia, Khosla, that are like partners there that make tremendous money. And they're all talented enough to go off and start their own fund, but they're just very comfortable where they are, right? And they make great money. As partners, they have equity in the fund, right? They have, I'm sure they have like some carry as well that they get. So they get a percentage of, it depends on what their structure is. Obviously, I'm not super familiar, nor will I speculate on like what their employment agreements are. but they probably get a percentage of like these exits as well, right? They have like a share in the fund's like overall profits and distributions as well. So you can make a ton of money as like a very senior partner in a VC. In fact, like emerging managers, like starting your own fund, I mean, you're getting paid off management fees. It's going to be a very long time before you see an exit. And in venture capital, I mean, the harsh truth is like it's an 80-20 rule, right? I mean, like 20% of the VCs are probably responsible for 80% of the returns, right? So a lot of VCs may never really have these like major exits, right? They may not invest in the next, Facebook or Apple or Nvidia or you name the company or the next Google or something, right? So yeah, I mean, there's obviously ways to get very, very, very wealthy in VC, but there's a lot of people that don't make a whole ton of money either. In terms of bonuses and stuff, of course, like every fund is different. The size of the fund in terms of like how much money they have and their AUM and the size of the fund that varies, the head count, the companies they invest in, that'll vary by company to company. But yeah, you'll get commissions and bonuses like you do in any other finance field. Maybe not commissions, more so bonuses, I would say.
Cool. Any more questions? All right. Let's give Andy a round of applause. Thank you very much for coming on here. Yeah, we appreciate it much. We're still a very new club trying to get things rolling, but your help is very much appreciated. So thank you.
Yeah, I really enjoyed it. Thank you everyone for coming. I appreciate. I know it's from what I hear, it was good weather in Buffalo today, and it was a Friday evening. So I'm honored and happy that you're all as students choosing to spend your Friday with me. What I will say, I'm happy to come back. This was really enjoyable. You all asked very, very intelligent and like sharp questions. I really enjoyed it. I'm gonna send Garrett a Google Doc just full of resources and job boards and books and podcasts and websites where I get information. But listen, I'm not gospel here, right? I mean, I'm just letting you know like what I kind of consume, and you guys could kind of choose to read or listen to what you all want to choose to read and listen to. But in there will also be job boards as well, where I've seen some pretty neat opportunities, a lot of which are on the East Coast, by the way, and a lot of which are remote as well. So I'll share that with Garrett, and then hopefully Garrett could circulate that with the group, and everybody should have my email, Andy at Behind Genius Ventures. I'm always down to talk and chat or help out in any way that I can.